Hi, this is Keith Schneider, CEO of MarketCage.com, and this is August 25th, 2016 edition of Market Outlook. First chart I want to take a look at is the one that I presented in the text, and we're going to do something a little bit different this week. I could tell you I went through all of the market indicators in a little big view, and no change, risk on. So what I really wanted to do is focus on the bigger picture and how we might use the bigger picture and understand where we stand and what the critical points are across the various U.S. indices. So let's take a look at this particular one, because this is the chart that I posted that is more akin to probably what Paul Tudor Jones is looking at and some of the bigger market players. So look, this is part one of an Elliott wave count. Here's part two, corrective wave. Part three, another impulse wave, right, where the market's moving up sharply. A corrective wave down. And also that fifth wave up. If you also notice the interval between high to high has already pretty much been reached. Now, depending on how you do the count, you might be off by a factor from the recent highs of plus or minus 4 to 6 months when you do these longer term Elliott wave counts. Remember, this is a chart really going back to the 1920s. What we're focused on is the current action, right? So here, again, high to high, and you'll notice that there are 2 degrees of trend lines, one using the bodies of the candles, one using the wicks. And no matter what you do, right, you have sort of this wedge or triangle type formation. And theoretically, we've already passed the point where we should have had the correction, or it's coming up over the September-October timeframe. So this is where we want to be cautious and let the market tell us if there's going to be a shift in trend. Another way to look at this on the Dow Jones, and this is the cash index, is to look at this whole area since the beginning of, or the mid part of 2014 as sideways compression. And we recently, you can see this trend line here, we broke out of that. Let's take a look at that in detail. So as you can see, just using the bodies, right, or the wicks on a closing basis, here is your trend line. We broke out. The whole Brexit thing sort of took a test of it, but meanwhile, we're moving out to new highs. It really should have been contained within that whole upward channel of the big pattern here, right? We really should not have broken out again to new highs. And so whenever you get a violation of a classic pattern, both in terms of time and price, it could mean a potential explosive move to the upside in this particular case, or a unusual move going counter to classic interpretation. Now, nonetheless, what we're going to do is we're going to look at a couple of key levels. Well, the first thing in the Dow is on a monthly basis, you can see what is critical is this faster moving average, which comes in right now around 17,500 or so. So for longer term players and just the view, I would be really cautious if we took out the breakout of this smaller pattern up here, right? Let me get the pen here again. I would be really cautious about a breakdown of all of this work right here, okay? All of this work here coinciding with the average, the longer term monthly average, and in addition, the upper bounds of the wedge formation. So in that case, that's where I would be cautious on a longer term basis. At the moment, market is still in play to the upside. But again, that's a good 1,000 point move from here. That's 5 or 6%. We can do even better with that, and I'll get into it in a moment. But what I really want to do is also compare this to the S&P 500, because you have a completely different looking story here versus the Dow. So in terms of classic chart patterns and looking at this, and remember, we're going back here, this is a log scale. This is a chart going back to the mid-90s, right? It's on a monthly basis. And again, you can see a completely different type of pattern. Now, obviously, you have this horizontal resistance line that we broke out of with a vengeance, right, in 2013, and have really not looked back, with the exception of a couple of thrusts recently below the faster 23-month moving average, which is this blue moving average line here. But nonetheless, if you look at it, this does not look like the same type of pattern we're talking about in the Dow, which is that wedge formation. This is completely different. It looks like you broke out above resistance really nicely, and you could get a much bigger move. In fact, if you take a look at it and project out what it could be sort of off of this double bottom, it can get you talking about a move potentially to about 400 in the S&P, and obviously that could take years to play out, but that looks like a possibility as well. Now, right, if the other things play out that we talked about in terms of the interest rate bubble popping and things happening, we need to have a place of protection. So I'm giving you longer term numbers. Again, the big number here in the S&P is really a break of 205 for your first, I would call that DEFCON 1. And you can certainly get a break back down to the 180 level and then ultimately the 162 level as well. But now let's take a look at the Qs. Again, different story. So when you look at the Dow, you have a much different picture than the other indices. Which one is correct, right? So we know in terms of time, we've sort of run out of time. Things should really start to break here if that Elliott wave count is correct. So take a look at the Qs, right? This had the biggest, gigantic move on the dot-com bubble out in 2000. And look at this. Over the last almost 2.5 years, we've been in a sideways type of movement. So this here is compression, right? And recently, we're starting to break out of this compression zone. Now that's in itself pretty damn powerful, right? I'm looking at this box here relative to these highs here. And again, key critical level, 107. This is showing 107.80, but that is really good. Notice how this fast monthly moving average kept this trend intact really since 2009. It did get tested on an intra-month basis. However, it never closed under it. So what we're looking for to see a potential trend change, right? You've got all these different indices. Obviously, you want to take note of these critical points and take action accordingly. But 107.80 is now the critical monthly number in the NASDAQ 100. And that's recently been on fire. And again, finally, after 16 years, really confirming the old highs and breaking out from it. So a failure at this level here would definitely, right here at 107.81 is your critical number. Otherwise, we are in risk on. Now, let's take a look at a couple of other things here, like the, um, the daily chart on the spiders. Let's see what they're showing here. So on the spiders on the daily chart, let's zoom in on the action here. And you can see that what's happened is around 213 is the critical moving average. So this massive breakaway gap scenario, you had two of them here with a breakout gap. If you violate that, it also coincides with your 50-day moving average. So that is that's what I would call sort of another level of important support in the S&P 500. Okay? Now, let's drill down even a little bit more. I'm going to go to another chart. Okay. So taking a look at our real motion, this is our momentum chart, and also a little bit more precision. As you can see, we've got a couple of things here. We've got this upward channel. If we could take out that upper end of the channel on a closing basis, you can really have some acceleration to the upside. Now, what we haven't been able to do is close under the 10-day moving average. But we did make a couple of attempts, which makes me feel like it's not as critical on an intraday basis, but on a closing basis, you may want to take note for those that are trading a little bit more actively or really, mini swing to day trading. Obviously, closes in the S&P under the 10-day moving average would be another level to be concerned about. But again, I wouldn't say risk on is off. Another thing to take notice of is, again, that 50-day moving average, which would take out all of this compression. And I put in here also a important support line. So the lows here coming in really around the 213 level and even a little bit higher, maybe even like around 214.50 would be important. So this level here would take out that support line, and all of this several weeks of work, maybe even, well, actually almost a month and a half of trading range, right? So this compression, if you violate that compression on the downside, you definitely want to be cautious. And then, of course, the violation of the 50-day moving average would be critical as well. So you've got important points looking at the bigger picture in the Dow. You've now got it in the Qs, right, which is around that 107, 108 level, and also three different levels, right, under the 10-day, under this line here, which comes in around that 214, 214.50 level, the 50-day moving average as well. And that would be more important, critical short-term trading levels. Now, in terms of looking at our real motion or momentum indicators, you can see that we're running true to the market, right? Our 200-day of real motion, market's well above it. Our 50-day of real motion, market is well above it. All of this is sort of consistent with how the actual underlying price action is playing out. So there you pretty much got it. Watch these levels. Stay tuned to those price points that I gave, and that's how we're going to play and look at these markets going forward. A lot of what the bigger players and the billionaires and everyone that you're hearing about, they're looking at those big Elliott wave counts. They could be off by months or just completely incorrect. One of the real possibilities here is that what's allegedly that last of that fifth wave up is exhausted, but when it is violated or not respected, it often means that an inverse of that is going to happen and a huge acceleration to the upside. So, considering all the events, and all the issues, the potential bubble in bonds, the geopolitical issues, the volatile presidential election, true, these are all backdrops. But price action and these price levels are going to dictate what you should do. At least that's our suggestion. Forget about what anyone says. Watch the action. Right now, trends are in gear across the board in equities. Okay, that's it for now. Hope you enjoyed it. See you next week.